Hi everyone, welcome back to Learn English with Erica. Today we are starting out with part 2 of our banking series. As promised, we're going to talk about credit cards versus debit cards, loans, mortgages, and credit scores, and why that should matter to you. Okay, so when you come to the United States, from whatever country that may be, things may be a lot different or they may be similar. Okay, so I'm just going to talk about things in the United States so that anybody coming from a country that maybe doesn't have credit card or access to loans can understand all the offerings that we have here in the United States. So first we'll talk about credit card versus debit card. So if you've gone to a bank and you've opened up an account, automatically you are able to get a debit card. This is a card that looks kind of like this. This is a pretend one, but it looks like this and it will say debit card on it. A debit card is something that you can take to an ATM. You can put the card in, you put a PIN number, a personal identification number that you never tell anyone else. It's only your number, right? It's usually 4 digits, 4 numbers. And you put that in and you can follow the prompts on the screen: deposit, withdraw, transfer, any of the same things that you could do at a bank during regular hours, during the daytime. You can use a debit card to do business at night, or when it's more convenient just to go to a machine and not talk to anyone. You can use an ATM and a debit card. So the debit card is going to require you to punch in a number. You can use it at the grocery store. You can use it, like I said, at an ATM. You can use it when you're shopping at the mall. A debit card is convenient, and the money for the debit card comes out of your bank account, okay, usually your checking account. And the difference between a debit card and a credit card is going to have one of these signs on it, like MasterCard or Visa or American Express or Discover. So the difference between a debit card and a credit card is that a debit card takes money directly out of your account, usually your checking account. A credit card is money given to you on a loan or borrowed. It's not money that is yours yet. You have not paid for this yet. It's coming from the big bank or the credit card company that offered you this credit card, right? So a debit card is safe because it will only let you spend the money that you have, right? So if you only have $500 in your account and you try to use your debit card for $550, it will not let you. It will deny it. And you'll know, oh, I don't have that much money in my account, right? So it's kind of safe, right? A credit card lets you borrow up to the credit limit that was given to you. A limit is the most that you could spend, right? So debit card, credit card, that's the basic premise between the two, right? You can also get a credit card through your credit union if you belong to one of those. And the amount that you're approved for or that you can charge on your credit card will depend on your credit limit, which we'll talk about in a second. Okay, so now let's talk about loans and mortgages. When you come to the United States, you may want to buy a car. And a lot of people who come to the United States will try to buy a car, their first car, in cash. This is a great idea. Okay, if you don't have to borrow money, don't borrow money, right? But if you work and you have cash that you've saved up and you want to buy a car, you can pay cash for that car. As you're here in the United States longer, you may want to trade up, get a bigger car, a better car, a nicer car, a more reliable car. Then you might want to think about taking out an auto loan, a car loan, right? You can get a loan through a bank or a credit union like we talked about in the last video. But remember, credit unions are probably going to give you better interest rates that you have to pay. So when you take a loan, you're agreeing that you will pay back more than you borrowed, right? So let's say a car costs $10,000 and you take out an auto loan or a car loan for $10,000. You will not just be paying back $10,000. You will be paying back that $10,000 plus what's called interest, right? So you'll pay every month a little bit of extra money for the bank or the credit union to let you take that big sum of money right now. Okay, so it's kind of like a trade-off. Okay, so that's a loan. You can take out a personal loan, maybe if you want to go to college or something like that. We have government loans that you can take out for college too. So a loan is essentially money that you're borrowing and promising to pay back. There's another type of loan that you might want to eventually take advantage of called a mortgage. A mortgage is when you want to buy a house and you want a bigger loan. Okay, a mortgage is just a loan, but it's a really long-term loan. So there's 15-year, 30-year mortgage loans. So you're taking a really big amount of money, promising to pay it back, paying it monthly, and you have an interest rate and a monthly payment for the 15 years or 30 years until you pay it off, right? So a loan can be as small as $1,000, whereas a mortgage is usually for like $100,000, right? So that's the big difference between those two. And for a loan, you're going to need less information than for like a mortgage. A mortgage, they're going to look at your credit history, they're going to look at your credit score, they're going to look at how long you've been at your job, if you have been renting, have you been paying your rent on time, so many things, right? So it's not easy to get a mortgage, but that shouldn't let you shy away from investigating or looking into it. If you have had a job for a while and you would like to buy a home, it's always smarter to buy a home if you can than to rent for like 10 years, okay? Especially if you know you want to stay in one place for a while, okay? So now let's talk about credit history. Credit history and credit score. Why do those matter? Well, when you are in the United States, inevitably, which means like more often than not, at some point, at some time, you will probably want to take out a loan, whether it's for a car or whether it's for a house. You will probably want to take advantage of a loan of some sort. You also might want to apply for a credit card, so that if you have an emergency and you have to pay for something but you don't have the money in your bank account, you can use your credit card. Remember, those are like MasterCard, Visa, Discover, American Express, okay, those bigger bank companies. So if you want to apply for a credit card or a mortgage or a loan of any sort, whoever is giving you the money is going to want to look at your credit report or your credit score. Your credit score basically tells the lender, the person trying to give you the money, it's telling them how reliable you are or how likely you are to pay back this money. So are you good at paying your bills on time? Are you good at paying your rent on time, etc.? Okay, so it's kind of a catch-22 when you're first starting out with credit because it's hard to get credit when you don't have credit. So you might want to start out with just a credit card first and maybe put your groceries on that, pay it off every month to build your credit, okay? So your credit score. So what you need to know about your credit score is that it's usually going to be a number. It's usually going to fall between 300 and 850. And the higher the number, the better. If you have a high credit score, that means that the banks or the lenders can trust you to pay back that money and pay it back on time, right? So you're more likely to be able to get a credit card, a loan, even rent an apartment, okay? Even when you're trying to rent an apartment, they will look at your credit score too. So how do you keep a high credit score? So the first and most important is to pay your bills on time. Try really hard not to miss a payment. It's so easy nowadays. You can pay online. You don't have to put anything in the mail with a stamp if you don't want to. You can pay it online right from your bank account. Okay, and your bank account, if you have checks, you'll have right here, you have a bank account number and you have a routing number. That's all you need to set up a link between your bank account and a credit card, or really anything else you want to use to pay out of your checking account. This information, you don't have to have a paper check to get that information. It's also online. And they also give you that information when you open a bank account. Okay. So to keep good credit score, you want to make sure you pay on time and you pay at least the minimum payment. The minimum payment will be listed on your credit card statement. It'll say minimum payments, usually $29 or something like that, $59. Make sure that you pay at least the minimum. It's even better if you can pay more. The more you pay, the faster you pay off your debt, right? So if you can, pay more. If not, that's okay. Just pay the minimum and pay it on time, and your credit score will go up. Another thing that people look at when they're looking at credit scores is your credit usage, right? And that's like a percent. So let's say you've been in the United States for a while and you have maybe 2 credit cards and you have a car loan, okay? And now you're looking at buying a house. They're going to look at how much credit is available to you, okay? How much have you been approved for? Maybe you have a credit card and you were approved for $7,000 as a limit, and you're only using maybe $100, okay? That's a really good percentage, a really small percentage of credit that you're using. If you use the small amount of credit, your credit score goes higher. And why would you want your credit score high? What difference does it make? You either get approved or not approved, right? Wrong. So once you're approved, there's even more benefits to having a high credit score. Once you're approved, then that credit score tells the lender what kind of an interest rate should I give them. So if I have a really good credit score, I'm going to pay less percentage per month for the loan that they're going to give me. Okay, on the other hand, let's say I have okay credit and the lender says, I think that she's going to pay back this loan. I'm going to give it to her, but it's going to cost her a little bit more because, maybe she had some late payments or something like that. So in that case, maybe instead of having a 3% interest rate, maybe I'll have like a 7% interest rate. And that means that every month I'll be paying back more in interest. It will take me longer to pay off the loan. Okay, so that's why you want a higher credit score. Okay, so once you apply for credit, you are either approved or denied. If you are approved, that means that's a yes. You can have this money, use it however you've said you're going to use it, and pay it back little by little. If you are denied, do not be afraid to ask why. You can ask, was it my credit score? Sometimes it's just because you don't have enough credit history. So the banks don't know enough about you to give you maybe that much of a loan. So that's why I say start out maybe with a credit card. Start out with a debit card if you have to, okay? But keep practicing spending your money wisely and paying back things that you've borrowed. If you have a credit card, even if it's only a $500 limit, if you pay it off, pay it on time, or at least the minimum balance, your credit score will keep going up, 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 and you'll have more opportunity to borrow money if that's what you want to do. Cash is always great, but there are situations where it's just not possible for someone to pay for what they would like in cash in that moment, be it a car, a house, whatever. So I hope that was helpful. If you have any questions, feel free to put them in the comments, and I look forward to seeing you back for day 3 and transferring money internationally, like via Western Union. I'll see you then.